Why is gold hitting all-time highs when U.S. interest rates are at a 20-year peak? Traditionally, this should have been the death sentence for gold, but instead, the charts are screaming breakout. The answer doesn't lie in Wall Street's technical playbooks. It lies in a massive migration of physical gold from west to east. We are witnessing the collapse of paper gold's pricing power. For decades, the global gold price was dictated by a few clicks in London and New York. You see, the old economic models told us that when the dollar is strong and yields are high, you sell gold. It made sense on paper, but today those models are broken. Why? Because a new force has entered the arena. While Western investors were busy trading digital contracts, central banks in the East, from Shanghai to Dubai, were quietly draining the vaults. They aren't interested in your IOUs or your ETFs. They want the bars, the coins, the heavy physical metal that no government can freeze or delete with a keystroke. In this video, we're going behind the scenes of this secret financial war. We'll explore how the Shanghai Gold Exchange is challenging the hegemony of the West, why the paper gold market is increasingly decoupled from reality, and what this tectonic shift means for your portfolio. Is the age of paper wealth coming to an end? Let's dive right into the heart of the vault. To understand why this world order is disintegrating, we first have to look at how Wall Street enchanted gold, turning it from a heavy physical metal into mere flickering numbers on a screen. For over a century, the global price of gold hasn't been set in the dark vaults of central banks or at the mouth of a mine in South Africa. Instead, it's been decided in two main hubs, the London OTC market and the COMEX in New York. This is the realm of paper gold. But what exactly is paper gold? Imagine a massive warehouse. Inside, there is one single gold bar. In a sane world, only one person can own that bar. But in the world of high finance, Wall Street has figured out a way to sell that same bar, or at least the promise of it, to 100 different people at the same time. These are what we call gold futures and ETFs. On the COMEX, traders exchange billions of dollars worth of gold contracts every single day. But here's the kicker. 95% of these traders have absolutely no intention of ever taking delivery of a physical gold bar. They are just betting on the price movement to make a fiat profit. It's a game of musical chairs played with digital certificates. Why does this matter? Because for decades, this mechanism gave the West, specifically the US and the UK, total control over the perceived value of gold. By flooding the market with paper contracts, they could effectively suppress the price, regardless of how much physical gold was actually being mined. If investors got too excited about gold, banks could simply issue more paper promises to balance the supply and demand on the screen. It was the perfect system to keep the US dollar as the undisputed king. After all, if gold stays quiet, the dollar looks loud and strong. Think about the sheer scale of this leverage. Experts estimate that for every 1 ounce of physical gold sitting in a registered vault, there are hundreds of ounces of paper gold being traded. It's an inverted pyramid of debt and promises. As long as everyone is happy with their digital receipts, the system works. But this creates a massive transparency gap. We are told the vaults are full. We are told the liquidity is there. But in reality, the market has become an elaborate hallucination. This paper dominance allowed the Western institutions to ignore the basic laws of physics. They could maintain high interest rates and tell the world, look, gold isn't moving, so our currency is fine. It was a psychological anchor that kept global capital flowing into Western bonds and stocks. However, a dangerous counterparty risk has been brewing beneath the surface. What happens if the music stops? What happens if the holders of those thousands of paper contracts all show up at the warehouse at the same time and demand their physical bars? The answer is simple. The warehouse would be empty within minutes. For a long time, this was just a theoretical nightmare for gold bugs and conspiracy theorists. But then the world changed. The geopolitical climate shifted from cooperation to confrontation. major nations started looking at the US dollar and the Western financial system it powers not as a neutral utility, but as a weapon that could be turned against them at any moment. They looked at the massive pile of paper promises in New York and London and asked a very uncomfortable question. If things get ugly, is that gold actually there? And even if it is, will they let us take it home? This suspicion began to erode the foundations of the Western pricing monopoly. The enchantment started to wear off. The East realized that if they wanted true financial sovereignty, they couldn't just play the West's game of digital betting. They needed the real thing. They needed to move the battlefield away from the computer screens of Manhattan and back to the physical reality of armored trucks and deep-level vaults.
And as we're about to see, they didn't just stop at asking questions. They started building their own arena, a place where paper means nothing and weight means everything. But that game of musical chairs only works as long as nobody asks the most dangerous question in finance. Don't give me the paper, give me the gold. And that is exactly what is happening on the other side of the hemisphere. While the West was busy digitizing everything, the East was quietly building a parallel universe. Enter the Shanghai Gold Exchange, SGE. Unlike the COMEX in New York, which is primarily a place for betting on price movements, the SGE is a physical delivery exchange. When you buy gold in Shanghai, you aren't just buying a flickering number, you are buying a bar that you can actually hold. The data from the World Gold Council confirms a startling trend. For the past several years, we've seen a massive arbitrage gap, often called the Shanghai Premium. Gold in Shanghai is frequently traded at a higher price than in London or New York. Why? Because the demand for physical metal in China, India, and the Middle East is so intense that they are willing to pay extra to ensure the gold is physically moved into their vaults. This isn't just investing, it's strategic hoarding of the world's most indestructible asset. But why the sudden rush for physical bars? To find the answer, we have to look at the BRICS Plus nations. They watched what happened to Russia's $300 billion in foreign reserves in 2022. In a single weekend, the West proved that digital wealth, dollars, euros, and bonds can be deleted or frozen with a keystroke if you fall out of favor with the US Treasury. This was the eureka moment for the East. They realized that if you don't physically possess it, you don't truly own it. This has led to the weaponization of gold. By accumulating physical gold, nations like China and Russia are building a great wall of sovereignty around their economies. Gold is the only financial asset that has no counterparty risk. It isn't someone else's liability. It doesn't rely on the SWIFT system, and it doesn't need permission from a bank in New York to maintain its value. We are seeing a strategic decoupling. The East is using gold to create a backdoor out of the dollar-dominated system. When China buys oil from the Middle East or minerals from Africa, they are increasingly looking for ways to settle those trades outside of the US dollar. And what is the ultimate collateral for a new non-dollar trading system? It's not a new digital coin. It's the shiny, heavy yellow metal sitting in the vaults of the People's Bank of China. The shift in power is visible in the numbers. In the last 2 years, central banks have bought more gold than at any time since the 1960s. But look closely at who is buying. It's not the Federal Reserve or the European Central Bank, it's the Eastern Bloc. They are draining the Western warehouses. Every ounce of gold that leaves a vault in London and moves to a vault in Singapore or Shanghai is an ounce of power being transferred from west to east. This is the physical reality hitting the digital illusion. The West still thinks they control the price because they control the paper market. But the East is proving that the paper market is a paper tiger. If the physical supply dries up because everyone is shipping it to Asia, the Western exchanges will eventually face a liquidity crunch. You can't settle a physical demand with a digital promise forever.
The East isn't just playing the game anymore, they are changing the rules. They've moved from being price takers, accepting whatever London says gold is worth, to being price makers. By establishing the Shanghai Gold price benchmark, they are telling the world the real value of gold is what people are willing to pay for the physical bar, not what a hedge fund in Manhattan thinks it should be. So, we have a world split in two. On one side, a Western financial system built on leverage, debt, and digital IOUs. On the other, an emerging Eastern system built on commodity-backed trade and massive piles of physical gold. The friction between these two worlds is what is driving the gold price to levels we've never seen before. But as this global tug-of-war intensifies, it raises a critical question for the average person. If the biggest players on the planet are scrambling for physical safety, what should you be doing with your own savings? Because as we're about to see, when the reset button is finally pressed, the difference between owning gold and owning a piece of paper will be the difference between survival and total loss. So, we've seen the grand chessboard, we've seen the East draining the West's vault. But now, let's bring this down from the billion-dollar central bank level to your kitchen table. Because when these Goliaths fight, it's usually the Davids, the retail investors, who get trampled if they don't know where the exit is. The biggest mistake most people make right now is staring at the daily candles on their phone, stressing over a 2% dip or a 3% gain in the USD price. But here is the hard truth. The central banks aren't looking at those candles, they are looking at their vault capacity. They aren't trading gold, they are exchanging a failing currency for a permanent one.
Think about it. If gold is truly dead or useless, as some critics claim, why are the smartest financial minds on the planet, people with access to every piece of classified economic data, buying it at a record-breaking pace? They are preparing for a reset. And a reset doesn't happen when everything is fine. It happens when the system can no longer sustain its own debt. Now, let's address the bear case. Critics often point out that if oil prices spike to $120 or $150 a barrel, it could force central banks to sell their gold to fund energy costs, potentially crashing the gold price. On the surface, that sounds terrifying, but let's look deeper. If a major nation is forced to sell its insurance policy, its gold, just to keep the lights on, what does that tell you about the value of their paper currency? It tells you that the currency is in a death spiral. In that scenario, a temporary dip in gold prices isn't a crash, it's the buying opportunity of a lifetime. It is the final window to trade your rapidly devaluing paper for the very thing that the world's most powerful institutions are desperate to hold. When the reset button is finally pressed, the price of gold in dollars won't matter because the dollar itself will have lost its meaning as a yardstick. What will matter is how many ounces you have, not how many digital zeros are in your bank account. This brings us to the concept of counterparty risk again, but this time it's personal. Most retail investors own gold through an app or a brokerage account. They see a ticker symbol like GLD and think they own gold. But as we discussed in the paper gold section, you don't own gold. You own a legal claim to a fractional piece of gold that might be leased out 10 times over. If the Shanghai Gold Exchange continues to drain physical supply from the COMEX, we could face a delivery failure. Imagine trying to withdraw your gold and getting a message saying, "Sorry, the vault is empty, here is a check for the cash value instead." But if that cash is losing 10% of its value every month due to hyperinflation, that check is a participation trophy for a game you just lost. You need to ask yourself, am I following the herd or am I following the masters of the herd? The masters, the central banks, are moving toward physical certainty. They are hedging against the very system they created. This isn't about being a doomsdayer, it's about being a realist. We are moving into an era where real assets will outperform financial assets. Whether it's gold, silver, or land, the goal is to own things that don't require a bank's permission to exist. Don't let the social risk or the tribe stop you. Your friends might call gold boring or old-fashioned, but remember, your friends aren't the ones managing the national reserves of China or India. When the dust settles, the people who understood the difference between a price and value will be the ones who survive the transition. The question isn't whether gold is going up or down tomorrow. The question is, when the current financial illusion finally evaporates, what will you have left in your hands? To wrap things up, we need to acknowledge a fundamental shift in the global landscape. The era of pricing gold based on nothing but faith in the US dollar is over. What we are witnessing isn't just gold getting more expensive, it's paper currency finally returning to its intrinsic value. As central banks across the East continue to prioritize physical weight over digital promises, the age of real assets has officially begun. The giants are moving their pieces. They are preparing for a world where liquidity isn't defined by how fast you can trade a digital contract, but how much physical collateral you have in your vault. This isn't a theory anymore. It's a massive, measurable migration of wealth that is redrawing the financial map of the world. So I want to leave you with one final thought to consider. If tomorrow morning the global banking system hit a pause button and digital transactions were suspended, what would you want to be holding? Would you feel safe with a paper certificate promising you gold from a vault thousands of miles away? Or would you rather feel the cold, heavy weight of a physical bar in your own hands? The choice you make today defines how you weather the storm tomorrow. But I want to hear from you. Who do you think wins this high-stakes war, paper gold or physical gold? Is the West's digital illusion still strong enough to hold, or is the East's physical reality about to take the crown? Drop your thoughts in the comments below. I read every single one of them. If you found this analysis helpful, hit that like button and subscribe for more deep dives into the hidden wars of global finance. Thank you for watching, and I'll see you in the next one.